Now we will discuss the ethical issues in corporate governance. As we have seen in the last discussion, when we were discussing the principal agency relationship, where the shareholder is the principal and the management is the agent, there could be some conflicts of interest in what the shareholders want from the corporate and what the managers want from the corporate. Regarding the shareholders wants more of profit, and the management also, through because they are involved in the day-to-day management of the business, because they are the people who are taking major decisions for the corporates. So they demand more prestige, more remuneration from the organization in return of the work that they are putting into the organization. To deal with this problem, like the conflict of interest doesn't hamper the smooth functioning of the organization, and to deal with other ethical issues related to corporate governance, then a body is there which oversees how the management is functioning. This body is called Executive Accountability and Control. This is a separate body of people that supervises and controls management on behalf of shareholders. So these are called executive or non-executive directors. So directors are a separate body of people that supervises and controls management on behalf of the shareholders. And there is a dual structure of leadership. There are executive directors and there are non-executive directors. Executive directors are actually responsible for running the organization, and non-executive directors are supposed to ensure that the corporation is being run in the interest of the shareholders. According to the Anglo-Saxon model, there is only a single tier in their board where the executive directors and non-executive directors are there together. But in the European model, it is a two-tier board. The lower tier is the executive directors and the upper tier is the supervisory board or the non-executive directors who oversees the functioning of the organization to ensure that the corporation is being run in the interest of the shareholders. So we can understand the non-executive directors have a major role to play to determine whether the management is operating based on ethical principles and whether they are doing justice to the shareholders' money or not, whether they doing justice to the other stakeholders also. So it is very important that the independence of the supervisory or non-executive board members are very essential, so that they are not having any personal self-interest in the organization. Let us find out what are the ethical issues in the independence of the supervisory executive board members. To ensure like they do not have any directly conflicting interest with the organization, where like their personal interests are coming in way of the organizational interest, to ensure that it is the way that the non-executive directors are drawn are majorly from outside the corporation. They are members who are taken from outside the corporation. They are people who do not have any financial interest in the personal financial interest in the corporation. The appointment is for a limited time, so that they don't start identifying with the organization as my organization and find it like a place of like investing in their self-interest. So the appointment is for a limited time. Then, as non-executive directors, those members are taken only those who are having the capability to judge the business of the company. They are competent enough to judge the business of the company. They must also be having sufficient resources to get information about the things happening within the organization, to do a proper survey, to extract information from the organization about things happening inside the organization. Next, they should be appointed independently by the stakeholders, and their appointment should not be such like they are having any personal interest, self investment of self interest in the organization. So these are pointers to check, like the non-executive board members who are expected to be in the supervisory role, to determine whether the management is functioning according to the interest of the shareholders or not, is very critical and done with utmost care. All these things are audited by an independent auditor, who is again appointed independently to see like the total functioning of the organization is done in a proper way. However, the ethical issues that may generate due to these factors are: first is that of executive remuneration. Though it is discussed like the non-executive board members have to be independent in nature, where they are not having any vested self-interest in the organization, it is very difficult to reach this situation. And when it is told like they get paid according to their time invested, and also they get paid in the other benefits based on the time invested and the other involvements, then that also sometimes becomes an issue of ethics. One of the major ethical issues that have cropped up in the field of ethical issues in corporate governance is that of executive remuneration. In many cases, it has been seen the executives enjoy a fat cat salary, a huge salary which is much beyond what the shareholders are getting their profit as. So, CEO increases the salary and it is beyond, or it sometimes doesn't take into consideration also the shareholder returns. Questions may come up regarding the ethical issues may come up regarding why the shareholders are going to pay for an executive who may not have performed well, or during their period the organization did not perform well. So, if it is the function of the executive to see that the organization is functioning to the best interest of the shareholder and it functions well, it has to survive and grow, then why in many cases where the CEOs like the mismatch of the salary that we are discussing about, why the shareholders need to pay for the executive salary even during the term when the corporation is not maybe performing financially very well? Why do they need to pay for their benefits of the CEOs is a debatable ethical question, the answer to which is not yet very clear, because people have again two, three different ways of thinking and their viewpoints to it. The ethical problems to deal with the ethical problems with the executive pay, it has in some companies it has been decided to performance related pay. However, these may performance related pay and then there was paid in terms of currencies which all shareholders understand. There is paying in terms of giving them shares in the organization at a future price, and because it is not only the organization is taking care of the by number of shares given, it is taking care of the you have to equate with the wealth of the executives also. So, this giving of shares to the non-executive board member may also act counter to the fact they have to maintain independence in the organization, and it may lead to large salaries that cause unrest within the organization and unrest in the mind of other shareholders also. The influence of globalization on executive pay leads to significant increases, because in different, as we have seen, like there is a difference in the frameworks of corporate governance. So also the executive remuneration varies across regions, and with the globalization coming in, so there are possibilities like the even after taking care of performance related pay, due to globalization executive remuneration is going to increase more, and this these are significant increases, and it with respect to the returns got by other shareholders. The board often fails to reflect on the other shareholders or stakeholders interest, and this is called the limited influence of the board. These are issues which are issues of debate, and the concrete answer to these are not yet available. Like, why should shareholders take the burden of paying an executive during whose tenure the organization has not performed well? So, do we allow increasing of the executive salary, which increases the gap between the lowermost level of employee in the organization and the CEO? So, what level of difference should be allowed, sanctioned within the organization? So, these type of issues are still debatable issues and need to be solved in future. Another issue can rise from the ethical aspects of mergers and acquisitions. Mergers and acquisitions are transfer of assets from one owner to another owner, in the expectation that the new owner will be able to use these assets for the best interest of the shareholders, use them properly, help them to reach a goal and make business out of it, and give a proper return to the shareholders, and it is to be used in a more productive way. So, however, there could be some ethical issues in mergers and acquisition, like during this transference of assets, whether it is more important, like the executive prestige, the profit and the share price, and how the executives are going to act during this merger and acquisition phase are very important. Two alternatives are possible. The first is called the golden parachute. In golden parachute, what is done, the organization which may enter into relationship with the executives and seduce them with a golden parachute for cooperation, which means they are given a very high amount for making this merger happen. They are given a very high amount for making this merger happen, and also to accept their redundancy. So, they have this golden parachute talks of two things: the it is an agreement which during which the maybe the host organization which is doing this hostile takeover is seducing the executives to say, put their nod yes for the merger to happen, and also to accept their redundancy in return for a huge amount of money. The opposite is in the greenmailing. Greenmailing is opposite to blackmailing, where in greenmailing the executives, they send some secret mails to the organization who is making the hostile takeover, to hinting that they will buy back their share in a future time with paying money which is more than the current market value. And then thus they retain their job within the organization. They secure their job with the organization after merger by using the corporate money. So, this generally happens in cases of hostile takeovers, where an investor or a group of investors intend to purchase a majority of the stake in a particular organization against the wishes of the board. And there we find shareholders can have two types of views. One view is that they want to sell, but the other prominent view is that they don't want to sell their shares. And through the process of golden parachute, the executives are approached by the organization making the hostile takeover with a large sum of money to ensure that they will help in the other shareholders to agree to the merger, and in return they will also accept their own redundancy. The greenmailing is also in the same context of hostile takeover, where the managers are securing their own job in the future organization at the cost of the corporate money. The intentions and consequences of mergers and acquisition in many cases are restructuring and downsizing. Sometimes in mergers and acquisitions, why these mergers are happening, what are the relative powers of the two firms which are getting merged together, and who is going to share how the power is going to get shared post merger. These informations are not there with the shareholders, small shareholders mainly at large. So, it may so happen that the merger and acquisition is done only for getting control of the assets which are more worthy in nature, to spread one's own business, to get the reputation, the brand name, and in that effort, what is mainly done after the mergers and acquisition, the restructuring and downsizing of the acquired firm, where the employees are the main target and the people have to leave after the acquisition is being done. So, this may make the post merger and acquisition the new firm formed may be more productive, but it may so happen that the demands and rights of some stakeholders beyond the shareholder only gets sacrificed. So, whether the other stakeholders' rights and demands are also answered properly, respected in the post merger situations. So, that becomes a point of debate again, because it mainly focuses to restructuring and downsizing. Another problem that may arise from the principal agency relationship is that of asymmetry of information, which may give rise to two things: the faith stocks and the insider trading. Faith stocks are what here the organization has not really made any profit, but based the executives based on their present performance have predicted the future performance, and that results in, that is based mainly on speculations, and these speculations do not reveal in reality the total amount of uncertainty involved, because all the stakeholders may not have an access to the true performance of the organization. The executive directors, the management, they can sometimes cook up the performance of the organization and make it look like that it is performing well, and may hide the risk involved. So, the speculation may not have a strong basis on the present performance, or the present performance may be misrepresented also. When we are focusing on insider trading, this is based on the asymmetry of information that the agents have due to they are members, or the executives have, due to the fact like they have got information from inside the organization, which maybe other shareholders who are not there in the board are not having access to. So, it is an access to inside information of the organization based on its present and potential future performance, which the other shareholders who are not directly involved with the running of the business do not have an access to. Insider trading occurs when securities are bought and sold on the basis of material non-public information. So, the word non-public information is very important. The ethical issues involved in this, because there was a lot of debate regarding whether insider trading is ethical or not. Should the accountants, should the analysts who have got some information from the organization after doing detailed analysis, should they be sharing it with all? Should not they be using it for dealing with their shares? Because these days, as discussed, the executives are paid in terms of shares, in how they are buying or selling the shares by using this knowledge, then why they are going to share it with all the shareholders? Because it is their hard or worked on knowledge that they have gained about the organization. So, these type of controversies, these type of dilemma give rise to ethical arguments with respect to insider trading. The four major ethical arguments with respect to insider trading are: first is finance, second is misappropriation of property, third is harm to investors and the market, and fourth is undermining of fiduciary relationship. Fairness is inequalities of information got by the people who are called insiders and people who are outside the organization. That's why it is thought to be an ethical issue. Misappropriation of property is when, based on these information that the insiders may have, they may start selling their shares or buying shares from outside. So, this is called misappropriation of property. Harm to investors and the market, because they have the access to information, because others do not have the access to information. So, others, even if they want, they cannot take proper steps in how they are going to behave with respect to the share that they are having for this organization. So, this in the long run may erode investors' trust in the organization, and so it is unethical in nature. There is a fiduciary relationship between the management and the shareholders. By using this power gained through insider trading, it is undermining of the fiduciary relationship, the trust relationship, where the managers have to think of the shareholders whose money the organization has taken and put in business, rather than what here it has been done. The organization's resources are used by the insiders to get certain information, which they use before it becomes public, before other shareholders are having access to these informations, and they use it for their own self-interest. So, this undermines the fiduciary relationship and leads to ethical arguments. So, as we have seen, it erodes the trust of the investors for this organization in the long term, and thus it is an illegal thing, and insider trading is to be avoided. The role of financial professionals and market intermediaries. Because insider tradings are happening, because shareholders are not having proper access to all the information about the organization, the accountants are expected to provide true and fair view of the firm and bridge the information asymmetry which is there between the shareholders at large and the executives or the managers inside the organization. However, there are 5 main problematic aspects of financial intermediaries' job. First is the power and influence in the market, like by auditing for a particular organization, and they gain power, and they may use this power and influence later in negative terms. Conflict of interest, they may be auditing for different clients, and cross selling of information is also possible. By auditing for a particular firm or on a long basis, though these auditors are taken to be independent auditors who are like maintaining fairness in reporting the true performance of the firm, then this long-term relationship with the clients may obligate them to show the firm's performance in a positive light. The size of the firm for which they are auditing is also very important, and there could be competition from other audit firms. So, in the urge to get a business and to retain the relationship with the corporate, the auditors may be driven to unethical ways of responding. Another change in perspective of accounting and auditing is with the changing nature of demand, the accountants and auditors along with checking of previous statements and finding out whether the performance of the organization is okay or not, and what is the true performance, they have to think of the potential shareholders also, and may have to predict about the future performance of the organization, and this based on the past performance, and this in order to give a picture of the organization to the potential shareholders. This is called creative accounting and may give rise to talking about faith stocks. So, this is another of the ethical issues when we are dealing with the role of financial professionals and market intermediaries in credit accountants and credit rating agencies with respect to corporate governance. Thank you.